Good day and welcome to our class on arbitrage trading in crypto. Now, there's no shortage of cryptocurrency enthusiasts touting how you can make money by investing in crypto. Hodling crypto, like Bitcoin, trading bots, dollar cost averaging, and arbitrage are some of the many strategies. Crypto's been around since 2009 now. It's become the darling of the market for a while. But we've all learned it's not an easy way to make money. Yes, sometimes you hit it lucky, sometimes you don't. But now that crypto has hit the mainstream, there are certain ways that we can make profit besides just buying and selling to go up or go down. But if the word arbitrage is new to you, you might wonder, what is arbitrage trading in crypto? Crypto arbitrage is a relatively low risk way to make money by buying an asset at a lower price on one exchange and selling it for a higher price on another. Fast transactions are crucial, and large profits typically require significant capital. Now, it becomes less and less, the bigger the crypto market gets, the less we have of the advantages of arbitrage. Several years ago, when we had lots of exchanges, but we didn't have all the charts and data feeding it from one exchange to the next, and they weren't getting their prices as quickly, and some slower exchanges who were updating maybe every 60 seconds instead of every 30 seconds, you could buy on one exchange and sell it almost simultaneously on another exchange. We still have those, because remember, trading goes on around the world and there's no centralized pricing, so it's decentralized. So you can find variations and fluctuations between the spreads and the buy and the sells from one exchange to another. So what you do is you buy your crypto on one exchange, sell it on another. So arbitrage trading is the process of buying an asset for a lower price on one cryptocurrency exchange and immediately selling it for a higher price on a different exchange. The difference between the higher and the lower buy-in price is your profit. Now, I do remember years ago, before we had Walmarts and Targets all over the place and mega chain stores, if you knew where there was a big chain who had a lower price and somebody you knew wanted to buy, whatever they wanted at the moment, and you knew I could go run over to Walmart and buy it for $5 less than he's going to pay for it in his local auto shop store. Say, okay, I'll pick it up, and he gives you $30 for whatever you're picking up. You run over to Walmart, buy it at a cheaper price at Walmart, and give it to him for $30 because that's what price he was paying at Auto's Depot, say. Okay. And it was possible. As Walmart and Target started to grow up all over the place, it's still possible. There are still pricing differentiations between small mom and pop stores, local stores, community stores. Look at the price in 7-Elevens and gasoline, station shops you pull into. You can buy beer at Walmart and stand outside the gasoline shop at the 7-Eleven and sell it all night long and make probably $1 a can. But the concept of arbitrage has been around for many years in traditional markets. But cryptocurrency offers unique arbitrage trading opportunities because the market stays open 24/7. Moreover, some people even have access to trading on crypto exchanges in various parts of the world. But worldwide trading isn't a given. Depending on your country of residence, that's one of the reasons that crypto arbitrage opportunities do happen. For example, South Korea's strict crypto policies prevent citizens from moving lots of money out of their country. They also don't allow foreigners to invest in South Korean crypto exchanges. As a result, the price of any given crypto asset on South Korean exchanges is often higher than in other parts of the world. It's such a common occurrence that it's even known by the name of the kimchi premium. So, if a South Korean buys a crypto asset abroad, they can often sell it on a cryptocurrency exchange for a profit. Now, there's other scenarios that create crypto arbitrage opportunities. These include exchange lag time. And this is what I mentioned before. You're dealing with, say, a U.S. exchange that is very quick, got all the numbers up to date, like, Binance or Coin, their prices are, and there might be a smaller crypto exchange that's just as accurate, but they're not uploading as quickly and they have lag time. And you can find the difference. And then we have favorable transaction and transfer fees. And then we have different price reaction times across the markets. There's going to be a different price reaction to a Japanese exchange from American exchange because of the time lag. If something happens in the middle of the night, everybody in China or Japan is still in bed sleeping. So arbitrage trading in crypto is a trading technique whereas traders purchase a crypto asset on one exchange and sell it on another for a higher price to earn profits, or the opposite. Arbitrage traders know that there are price differences for the same asset since one cryptocurrency may be available on several exchanges. Therefore, the traders simply buy the asset on one exchange for a low price and quickly sell it for more on a different exchange. Now, you used to be able to do this quite profitably for Bitcoin, but once Bitcoin got up to, even today, after the crash of this past year, it's still at $17,000 or $18,000. Well, if it goes up a couple dollars or even a couple hundred, if you only have 18,000, because you can't use leverage, because you're actually physically buying it, you're not physically, but on the exchange, you actually have to have that cryptocurrency, and because you can't sell on a different exchange if you use leverage trading. So most crypto markets are not regulated, and cryptocurrencies are decentralized, and therefore, and except for stablecoins, are not pegged to government or fiat currency like the dollar. This is one of the primary reasons why the price of different cryptos can vary widely. There is no standard price for any such coin or token. Now, forget doing arbitrage trading in outside the top 10 majors, because then you come into a liquidity problem. You might want to go over to those other exchanges listing it and try to sell it, but they may not have any buyers. Okay, so stay away from all of these newly minted digital assets and digital coins and tokens. Some crypto exchanges are bigger than others with higher trading volume. Thus, the supply and demand of one exchange could be quite different from another, affecting the price. Finally, crypto trading fees also vary, and you can add to the cost of your trades. Now, there are some different ways investors can conduct crypto arbitrage with different types of cryptocurrencies. There's spatial arbitrage. Spatial arbitrage involves trading virtual currencies across two different exchange platforms. Spatial arbitrage is a straightforward way of conducting crypto arbitrage. While this is a simple tactic that can be taken advantage of to take advantage of price discrepancies, spatial arbitrage exposes the trader to risks like transfer times and costs. Some traders try to avoid the risk of transfer costs and times that spatial arbitrage poses. For example, in a hypothetical case, they may go long Bitcoin on one exchange and short on another, and then wait for the price on the two exchanges to converge. That allows them to avoid transfer coins and tokens from one platform to the other. However, trading fees may still apply. Then we have triangular arbitrage. Triangular arbitrage takes advantage of price inefficiencies among different pairs of cryptocurrencies on the same exchange. With this strategy, an investor starts with one cryptocurrency and then trades it for another cryptocurrency at the same exchange, one which is undervalued relatively to the first cryptocurrency. The investor would then trade the second cryptocurrency for a third cryptocurrency, which is relatively overvalued when compared with the first. Finally, the investor would trade the third cryptocurrency for the first cryptocurrency, completing the circuit potential a little richer. Then we have interest rate arbitrage. Many cryptocurrency exchanges offer borrowing and lending options to their users. However, the interest rate they offer varies. So you can borrow an asset like Bitcoin at a low interest rate from one exchange and then lend it for a higher interest rate on another exchange. And then statistical arbitrage. Bots use statistical arbitrage, but some traders with a background in designing or reading mathematical models can choose a personalized statistical approach to arbitrage trading. Python is a popular tool for algorithmic arbitrage trading. Doing so opens a potential opportunity for more arbitrage trades. However, this skill takes time, which is why many traders rely on bots. Bots use statistical arbitrage, but some traders with a background in designing or reading may do something differently. So, how do we take advantage of arbitrage algorithmically? At first glance, cryptocurrency arbitrage seems like a simple matter of looking for gaps between prices on one exchange and another and then executing a buy and sell. Famously, in 2007, there was a moment when the price of Bitcoin on Kraken was at 17,212, but only 16,979 on Bitsmart, presenting an arbitrage opportunity. In that instance, an investor could potentially make $233 for each Bitcoin by buying them on Bitsmart and selling them instantly on Kraken. While spreads aren't always as wide as in the above example, there are times when others, less well-known forms of cryptocurrency could offer even wider gaps. Now the problem again is to make that $233 profit, you had to have $17,000 in cash or coins to buy it at one platform and sell it at another, because just your account balance isn't following you. So looking at lower price, the popular, Dogecoin, even Ethereum, coins that are lower values that you can afford to buy more coins. So there are a number of apps investors can download that will track the price of Bitcoin and other cryptocurrencies for arbitrage trading. This way, investors can take advantage of algorithms that automatically scan for arbitrage across different crypto exchanges. This automatic approach can allow crypto arbitrage traders to take advantage of multiple different price discrepancies. Now, it gets a little bit more complex, and especially when you're trading bots, because you could just buy a bot. But if you're just buying a bot without customizing it, it's the same bot everybody else has. They're scanning for all the other things. But bots are very easy to personalize and customize, and that will make what you're looking for a little bit more unique. Now, arbitrage trading can be time consuming since you have to look for price discrepancies among multiple exchanges. By using a bot program, your bots can automatically scout out and execute arbitrage opportunities for you. So the question is, how do you find a crypto arbitrage? Not every cryptocurrency digital asset is created equal when it comes to arbitrage, and there are multiple ways to find arbitrage opportunities. So method one is, with so many different cryptocurrencies on so many exchanges, finding those opportunities is a daunting task. That's why many traders use software applications to track hundreds of cryptocurrencies on different exchanges in real time. There are a growing number of companies that specialize in software to automate crypto arbitrage. Some companies have a tool that allows investors to choose an automatic arbitrage strategy and execute it across different exchanges. And then method two, investors can find bigger price spreads for the same cryptocurrency among less popular, less frequented traded forms of crypto. Because they are less popular, though, these cryptocurrencies are prone to rapid price fluctuations. That volatility can be good or bad news, but it adds another level of risk to arbitrage strategies. Now, arbitrage in decentralized exchanges operates with liquidity pools rather than order books. That means people can automatically buy and sell their crypto assets, given that a pool of those assets are already in waiting. Assets on a decentralized exchange vary in price according to the people who provide liquidity by voluntarily placing their crypto assets in a pool. A formula ensures the ratio of assets and their pairing remains balanced. Choosing between decentralized and centralized exchanges can be tricky, but it also be the specific case that depends on your needs. But when a large buyer swoops in, it can offset the price of the purchased asset and the coin paired with it. The decentralized MakerDAO is one example. MakerDAO operates on the Ethereum blockchain and provides liquidity to its users through its stablecoin DIA. So if you want to buy DAI from a DAI Bitcoin pool, you have to deposit Bitcoin into the pool to be able to remove the DAI. This results is that there will be more Bitcoin in the pool than the DAI at the moment. The decentralized exchange will then lower Bitcoin's price and increase the price of the DAI. The result is that more people want to buy the Bitcoin at a lower price, adding more DAI back to the pool until the price stabilizes and the DAI and the Bitcoin price on other exchanges. In the meantime, arbitrage traders, including those that change the ratio of the pool by making large DAI purchases, can profit from the price differences. So keep in mind, there are dangers of arbitrage trading. Like with any kind of arbitrage, crypto arbitrage involves some potential risk, and keep that in mind at all times, because timing is everything. The crypto market is notorious for being volatile, and since it's open 24/7, there's always the potential for a massive spike or a drop. So you could get unlucky and buy a crypto asset, and the market could plunge before you have time to exit your arbitrage trade and profit. Another timing issue is the delay that sometimes happens to make a transaction on a blockchain. Now, this becomes crucial. Some exchanges don't initiate the blockchain transaction as fast as others. Okay, there's times that they're depending on the fee that you're paying also is how fast it's executed. So you need to be aware, because if you're sitting for an hour waiting for your transaction to be cleared, you may run into some problems. So suppose you choose to trade a cryptocurrency with a slower average transaction time, or a time when the network has a lot of traffic. In that case, you could lose a profitable arbitrage trade while waiting for your buy or sell orders to process. Since the profit margin is typically so low in arbitrage trading, every fraction of a coin counts in your buy and sell trades. So price and fees are very expensive. Slippage is the concept of your buy and sell order executing at a different price than you anticipated. In some cases, this can work in your favor, but slippage can also cause an arbitrage trader to lose some, if not all, of their potential profit. And exchange fees can also make a dent in your profit. If you're not careful, you can even lose money from arbitrage trades due to the higher than expected exchange fees. High fees are most common for low volume traders, as most centralized exchanges operate on a tiered system, offering lower trading fees according to the 30-day trading volume. And that doesn't even include the blockchain transfer fees that you need to pay for transferring a crypto coin between exchanges. It's easy for newbies to miscalculate or underestimate the cost of exchange fees. For this reason, a bot can be helpful, as they typically factor in the anticipated cost of fees before choosing to execute a trade. So in some final thoughts, some crypto arbitrage traders might spend their days at their computers monitoring exchanges for price discrepancy opportunities. Others may use bots to automate the process. While arbitrage trading with crypto can be profitable and is less risky than certain other crypto investment strategies, there's still potential for you to lose money. So we encourage you to do your due diligence before deciding whether there is a trading method you want to implement. But keep in mind, because in order to arbitrage cryptocurrency, you have to own them. You're not trading on an exchange. You're not using leverage or margin trading. You're buying a Bitcoin for 16,000 over here to sell on that exchange at 16,100. But you actually bought it for the 16,000. So you own it. So if something does happen before you go over to execute your arbitrage trade and Bitcoin dropped down and they're only offering 15.9 and you bought it at 16 because they were at 16.1 before, you just don't do the trade. You can sit on, you own it. So you're not being leveraged to have to sell it at the moment. So you might take 100 or 200 loss, but you can sit on it till the market trades in your favor or moves in your favor because you're not trading. You own it. You could sit on it as long as you want. So, but keep in mind there are risks. So that's all for today, folks. Thank you very much for joining us, and look it for our video on bots and automated trading. Thanks now.